April 2026. The data isn't subtle anymore. Inflation remains persistent. Interest rates are still elevated. And the cost of living continues to outpace wage growth for millions of households. The Consumer Price Index, CPI, has not returned to pre-2020 stability. Core inflation, the metric that excludes volatile food and energy prices, continues to signal underlying pressure in the economy. At the same time, central banks, particularly the Federal Reserve, have maintained restrictive interest rates in an attempt to control that inflation. The result? A tightening financial environment where borrowing is expensive, savings are under pressure, and economic resilience is no longer optional. This is not a prediction. It's a structural shift already underway. To understand why this moment is different, we need to look back. In 2008, the global financial crisis was driven by systemic failure inside the banking system. The response was aggressive, interest rates were cut to near zero, liquidity flooded the markets, and credit became widely accessible. That playbook no longer applies. Today, inflation is the constraint. Central banks cannot simply inject liquidity without risking further price instability. Lowering rates too early could reignite inflationary cycles that policymakers have spent years trying to control. At the same time, external pressures have intensified. Global geopolitical instability, particularly in energy markets, has disrupted supply chains and increased production costs. This has created a feedback loop where prices remain elevated even as growth begins to slow. Consumer strength, often cited as the backbone of the economy, is now showing signs of fragmentation. While some households remain resilient, others are increasingly reliant on credit to maintain basic consumption. This is not a collapse driven by panic. It is a slow compression driven by policy limits. In an environment like this, survival is not about prediction. It's about positioning. There are three pillars that define financial resilience in a high-rate, high-cost economy. Pillar 1, liquidity. Liquidity is not just cash. It is flexibility. In a tightening cycle, access to capital becomes restricted. Credit lines shrink. Lending standards tighten. And opportunities, both risks and advantages, appear with little warning. Households with accessible reserves are not just protected. They are adaptable. This is not about maximizing returns. It is about maintaining optionality in an uncertain system. Pillar 2, debt reduction. In a low-interest world, debt can be manageable, even strategic. In a high-interest environment, it becomes a compounding liability. Variable rates adjust upward. Minimum payments increase. And the cost of carrying debt begins to erode long-term stability. Reducing exposure to high-interest obligations is no longer a conservative move. It is a structural necessity. Not to optimize wealth, but to preserve it. Pillar 3, risk management. The modern economy is no longer defined by single-point failures. It is defined by overlapping risks. Geopolitical instability. Policy constraints. Market volatility. Managing risk today means understanding exposure. Income concentration. Expense rigidity. Dependence on external systems. Resilience comes from reducing fragility. Not eliminating risk, but distributing it. The 2026 recession, if defined purely by traditional metrics, may still be debated. But for millions, the conditions are already here. Higher costs. Tighter money. Reduced margin for error. This is not a cycle you wait out. It's one you prepare for. If you want more breakdowns like this, fact-based, signal over noise, subscribe to the Survival Ledger. Because in this environment, information isn't just power. It's protection.